Hello and welcome to Chapter 10 Workout Problem video. Let's go ahead and begin with Problem 1. So this problem is about account balances. In 2001, the economy of the United Kingdom exported goods worth £192 billion and services worth another £77 billion. It imported goods worth £225 billion and services worth £66 billion. Receipts of income from abroad were £140 billion, while income payments going abroad were £131 billion. Government transfers from the United Kingdom to the rest of the world were £23 billion, while various UK government agencies received payments of £16 billion from the rest of the world. So in this problem, we're going to do three things. Number one, we're going to calculate the UK merchandise trade deficit for 2001. Next, we're going to calculate the current account balance for 2001. These are two different things, right? And finally, we're going to explain how we decided whether payments on foreign investment and government transfers counted on the positive or the negative side of the current account balance for the United Kingdom in 2001. Let's go ahead and calculate the merchandise trade deficit for 2001. So we're going to include the imported goods worth $225 billion, and we're also going to count the 192 billion pounds of exported goods. So in this one, we're just counting goods. We're not counting services or any transfers. That gives us a total of 33 billion. That's actually a deficit, because the 225 billion are our exports, right? So this is, our imports, I'm sorry. These are our imports. There we go. So these are our imports right here coming into the country, and these are our exports. So in the case of trade, exports are good, I guess you could say, and imports are bad, in the sense that the more we export, right, that's kind of like revenue. We get paid for those. The imports are things that we have to pay for. Okay, so in this case, because our imports are greater than, right, they're greater than the exports, then this 33 billion pounds is a deficit, a trade deficit. Next, let's go ahead and calculate the current account balance. And this really is the calculation, so we're going to go ahead and throw that out here first. We're going to take net exports plus net income from abroad plus net transfers. So here's our net exports. So we have 269 billion minus 291 billion. And then so this right here is our net exports right here. So this right here is our exports, right? Within the net exports, we have exports. Okay, so in this case, we're doing our exports minus our imports. A lot of times, like in the book, for example, we would have it noted as this. So this would be X minus M. Okay, and so in that case, it's going to be the 269 is our 192 plus our 77, right? These are our exports. Imported goods and services of 291 is going to be our 225 plus our 66 billion. So those are our imports, right? And then we're going to go ahead and add our net income from abroad. So this is our net income from abroad, right? This is our 140 billion. Receipts, that's receipts from abroad. And we're going to have our payments going abroad as 131. So this is our receipt, and here's our payments that we're making, right? So this is it's going out payments. And then we're going to go ahead and add our net transfers, which are these right here, right? This is our transfers from the UK out is 23. So that's our going out negative. Our 16 is payments received. So these are the incoming, right? So this is received, and this is uh, our this is paid, I guess you could say, paid out. So in that case, right, we're going to have um, a negative 20 billion is really how it's going to work on this. This one actually turns into a negative, right? Plus a negative. On this case, it's going to be a negative because our paid out is larger than our received. And our in this case, this one's a true positive right here. Net income from abroad, we actually received more than we paid out. All right, so this is going to be a negative in the end. And then, of course, uh, our imports are also going to be a negative. This is going to be a negative number because our M is bigger than X, right? Imports are bigger than exports, so that's going to be a negative. So it's going to be this negative plus negative exports, positive net income from abroad, but then we're going to have negative transfers. And so all in all, it's going to be a total of negative 20 billion pound current balance. Next, finally, explain how you decided whether payments or foreign investment and government transferred out counted as positive or negative on the side of the current balance. Okay, and so again on the uh, on our exports, net exports, we're going to say if imports are greater than exports, then it's going to be a negative, right? That's kind of the rule there on there, and then also foreign investment. In this case, it's going to be if our uh, outgoing or our paid out, right, is greater than our receipts, then it's going to be a negative. And that in our case, it actually was a positive, right, on the previous slide. And then government transfers, of course, it makes sense that it's going to be the same way, right? Our paid out versus our received, if our paid out is going to be larger, then it's going to be a negative as well on that. So go ahead and type that out as well. So problem 2. Imagine that the U.S. economy finds itself in the following situation. So a government budget deficit of $100 billion, total domestic savings of $1,500 billion, and total domestic physical capital investment of $1,600 billion. So anyways, the A here, it says, according to the National Saving and Investment Identity, what will be the current account balance? So let's take a look at this. So our account balance, there's a couple different ways of looking at this, right? So in the book, it explains, and you can kind of read it and see some examples as well. But here's a good example: is there's the supply side of financial capital and there's the demand side of financial capital. Okay, on the supplied side, we have savings, right? That's our own internal people, right? And businesses that are saving, right? Households and businesses are saving. Individuals, households, and businesses. And then we have our current account deficit, okay, on there. And then, and really that is, we could also get a supply from outside. That's what that's saying, right? The supply of financial capital is coming from outside, so we have a deficit, right? And then we have demand for physical capital. So our government borrows money, right? So that's one demand. They're wanting financial capital to invest in the country, build highways, and to also build, army tanks and all those things that the governments do and spend money on. And then we have physical investment, which is going to be the the demand that businesses or individuals have for financial capital to use in their personal life or in their businesses to build and invest in the future. Okay, so under the blue here, now we're going to say, okay, what is our current account balance? So in this case, we have total domestic savings, right? So these are the people right here that are saving their money. People, households, and businesses, firms that are saving their money. So that's our 1,500 billion there. And then we know current balance deficit is going to be added, subtracted, right, netted out on that to get our supply. And then on the other side, we see that total domestic physical capital is 1,600 billion, right there. Physical capital investment by businesses, individuals, all of that stuff. And we also see up here, so that's gonna, right, so this is coming down into here. So this is our physical investment. 100 billion is our government deficit. That's gonna come down in here. And then there are 1,500 billions right here. So really the question is what is our current account deficit? Well, now all we need to do is we just need to solve for the difference in this case, right? And so we could subtract 15 billion from both sides, right? Because we're trying to isolate the current account deficit here. So we're going to take our 15 billion over to this side, or 1,500 billion, I should say. And then so it actually ends up being, and that's going to be subtracted there. So it's going to be 200, right, billion dollars is going to equal our current account deficit. If we go ahead and work this math out, right? So subtract 1,500 billion from both sides, gets rid of that, takes it over here, and then we go ahead and do our 100 billion plus 1,600 billion minus 1,500 billion. That's 200 billion. That's our current account deficit. The next part of this problem says what will be the current account balance if investment rises by $50 billion while the budget deficit and the national savings remain the same. Okay, so in that case, $50 billion investment or increase in our investment, right, will increase the deficit to 250. What's changing here is the demand side. So we have over here, we have the supply side, right? So here's supply, right? And it has to equal demand. That's really the idea, right? So we got our demand. And really what we're saying here is the demand side, this 15 billion right here is what increases on this side, right? So, or 50 billion. The demand side is made up of government budget, right? Deficit, and it's made up of investment. So the investment's part of the demand side. So if this increases by 50 billion, everything else remains the same, then our trade deficit on this side is going to go up 50 billion as well. It was 200, right? And so we're going to add 50 billion to that, and so that gives us 250 billion dollars on that. So that's where we get our answer there. Now we're going on to problem 3. This table right here provides some hypothetical data on macroeconomic accounts for 3 countries. So country A, country B, and country C. And measured in billions of currency units. Private household savings is SH, right? So this is our savings. Tax revenue is T, so this is tax right here, right? G is our government spending, and I is our investment. Here's investment right there. There we go. Okay, so this So that's kind of how the data is lined out here, and we're going to go ahead and solve some problems using this data. This is trade balance. All right, let's do problem 3, trade balance calculation. This table provides some hypothetical data on macroeconomic accounts for 3 countries representing country A, B, and C, and measured in billions of currency units. Private household savings is SH. Tax revenue is T. Government spending is G. And investment spending is I. So the main idea of this problem is we're trying to get at the trade balance. The trade balance is the imports minus the exports, right? So we want to know how much we're borrowing from the rest of the world financially as we do our trade. And so that's really what's counted as foreign inflow of foreign saving. SF from each country really is a component of our, or is the output of our trade balance. So let's go ahead, and there's several ways to look at it. So this is the current account balance is related to the trade balance, right? Because the trade balance is part of the current account balance calculation. Let's go ahead and do the calculation for the first country, A. Here we have $800 worth of investment minus $700 worth of savings, and then we're going to actually subtract the government component. That is taxation minus government spending. In this case, it's actually a negative 600 is the component that we come up with here. So one thing to remember here is this, right? This negative sign, when we subtract a negative, that's going to be adding. So what we got is 800, right, minus 700. In this case is 100, right? Right there. And then our negative, we're subtracting a negative 600, which is actually like adding it, right? So then we have 100 plus 600 equals 700. So what does this mean? We'll talk about it a little more in the next slide. So here's country B's calculation. That's a negative 250. And country C's calculation is 0. Moving on, this is the next slide. So state whether each one has a trade surplus or a trade deficit or a balanced trade. So what we're looking for here is country A is 700, right? This is actually a surplus, right? So this is a trade surplus. Country B, we have a trade deficit, and then country C is balanced trade. Next, this part may get a little tricky, just understanding how this works. So state whether each is a net lender or a borrower internationally and explain why. So country A is a borrower. So the reason it's a borrower is because we're getting more from other countries than we're giving. So in this case, when we do that, we're actually borrowing. Okay, so we're actually borrowing more on the total trade balance side of things, right? Country B, where we have a trade deficit, and in this case, we're actually lending. We're a lender to the rest of the world in that case. We're lending them our wealth, so to speak, right? And then in C is neither, right? So it's just balanced. It's neither a borrower nor a lender. Next, our problem 4 is the percentage of GDP. It says, imagine the economy of Germany finds itself in the following situation. The government budget has a surplus of 1% of Germany's GDP. So that's great, right? So that right there, the budget is going to be the government taxation, right, is going to be larger than the government spending. Private savings is 20% of GDP, and physical investment is 18% of GDP. Okay, so this one, since it's a surplus in the budget, that's actually going to be a supply of financial capital. This right here, private savings, is also a supply. Physical investment, that one is going to be our demand component. So based on the national saving and investment identity, what is the current account balance? Let's take a look at this, right? So here's our investment minus our savings, and then we're going to have our tax minus our government spending. So this is the investment and the saving component, right? It's going to tell us how much internally we're saving. Tax and government is going to say this is our governmental activity. Okay, so we're going to plug this in. So this is our 18%. It's coming down on the demand side. 20% is our supply side, right? So we're actually supplying 22% more in this case. And we're going to have our 1% is the government component, right? So the national saving and investment identity is going to be negative 3% of GDP. Okay, so we're actually going to be saving money in this case. And the government budget surplus falls to 0. What happens if that happens? Well, we're changing this component, right? So the negative 1% is going to go to 0, and then it's going to change to negative 2%, right? And that's something that we kind of see since our budget is we're spending just as much as we tax right now in this case, just as much as we tax. Then our national saving and investment identity, we're going to be saving, in this case, 2% of GDP. Which is how the way the numbers are set up in this one, it looks like a negative GDP, which looks like negative saving, but it's actually negative investment. Investment is the demand side, right? In this case. So anyway, so it's a negative 2% GDP as an answer on that